Hi, it's Jacob, and today I wanted to do a little bit of a different video, and I wanted to explain why I'm so confident in my investment strategy and why I'm so confident that this strategy beats virtually every investment advisor in Canada. The reason that I'm so confident in this strategy is because it's actually not my strategy. This strategy is unequivocally endorsed by the best investors of all time and is based on 90 years of historical data. So I put together some video clips of the best investors in the world giving their investment advice. And what I did was I put them side by my own videos. And what I want you to recognize is that when I am giving investment advice in future videos as well as current videos, that investment advice is not my advice. That is literally the best investment advisors in the world giving me advice and me just sharing them with you. I do want to caution that this video is a little bit long. But I do recommend that you drink in and absorb every single word that they say, because what they're saying is extremely important. Number 2 is buy all companies, or buy a whole ton of companies, 600, 1,000 companies. And later on I'll show you how to buy an index, and specifically certain kinds of indexes.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm.
And idea number 3 is never sell.
Okay, buy right, hold tight means don't make mistakes at the start, pick a good fund, and hold it through thick and thin. And I would argue very strongly, if you're looking at an actively managed fund, and you should be very careful to buy the low-cost ones, even if it's actively managed, that don't get despondent when it does badly, because it comes and goes.
As you can see, in the last 10-year period, only 1.67% of investment advisors were actually able to beat the index.
Forget the needle, buy the haystack, you buy the whole market. Why?
Yeah, well, it's because buying a good manager is like looking for a needle in a haystack. And everybody knows what that's about. Good old Don Quixote had it about right. And so it just makes common sense. Own the whole market and not just a few stocks. You don't need to take the risk of individual stocks. Take the market risk, which is quite high enough. You don't take both.
So today I share with you my strategy, and it's part of the 0.01% of investment knowledge that's out there, and it's honestly all that you really need to know.
The hedgehog beats the fox.
The fox knows many things, but the hedgehog knows one great thing. And in our business, the foxes are all those managers smarter, they got all those computers, all those brilliant Harvard Business School graduates, armies of them, and they know everything. They know far more than I could dream of knowing. I know one great thing, and that is if you own the market, which they do collectively, naturally, if you own the market, you are guaranteed, in a low-cost index fund, you are guaranteed to earn your fair share of whatever the stock market is kind enough to give us, and let's be very clear on this, whatever return a bad market is mean-spirited enough to take away from us. So it's the hedgehog who wins.
I'm a logical person and very analytical, so here are some numbers to explain my rationale. JP Morgan recently did a study, and they tracked the stock market between 1995 and 2014.
JP Morgan did a study, and Schwab, both independently did studies over 20-year periods of time, so 1996 to 2015.
And what they found was in 20 years, if you missed the best 10 days of the market, your return will have dropped from 9.85% to 6.1%.
But in those 20 years, if you just missed the 10 best trading days, 10 days out of 20 years, and your return would be 4.5%. It would literally almost be cut in half just by missing those 10 days. How are you going to know in 20 years which of those 10 days are?
So idea 3 is don't get off the roller coaster. Do not sell into panic.
And your final rule for investors is stay the course.
The markets are really, just think about this for a minute, really counterintuitive, because when do you feel you're most optimistic and most happy and enthusiastic about buying stocks? At the market peak. When are you scared to death about stocks and really want to get out? At the market bottom. So you get in at the top and out in the bottom. Do you think you're going to do well doing that? So figure out a sound program, set the right course, and then don't let all these superficial, emotional, momentary things get in your way. Another way of putting it is, don't do something, just stand there.
The big money in investing is not in the buying and selling, it's in the waiting.
And the greatest investors, many of the greatest investors of all time, don't believe in market timing. So Buffett is not a market timer. You don't see him leave the market and go to cash. You see him 99% invested all the time. And when the market is correcting, he looks for value. He doesn't try to time it. He buys, he waits. One of the big misperceptions is, okay, if the market's at 10,000, like it was a few years ago, and I wait, well, there are only three things that can happen if I'm in cash. One is the market goes down. I feel great. But am I going to go in at 9,000? Do I really feel great about the market at 9,000 if I didn't feel good at 10? I still have not met that investor in my long career. Second, it goes sideways. I lose. Dividends are better than being in cash or a CD. Third, it goes up. Now, the problem with it going up is it might not come back to 10,000. It might do exactly what it did. Go to 11, 12, 13, 15, 19, 9, You
lost your opportunity.
You've lost your opportunity. Now, if I go in, there's three things that can happen. It goes up. I'm high-fiving everyone around me. It can go sideways. I'm better than cash. It can go down. Big deal. I can buy more or I wait it out. That's the worst thing in the world that happens is I wait it out. So being out, it's like Tony said, it's counterintuitive. Being out is what results in permanent loss. Being in, the worst outcome that can happen, and it's still a low probability event, is temporary loss of capital. Bogle said, I've not only never seen anybody can do it, I've never met anybody who met anybody that can do it. And I'll tell you, at Creative Planning, we have 15,000 clients. I've been doing this about 20 years. I have never in my career, ever, seen a client exit the market and get back in even moderately close to the right time. I mean, forget about getting it right, not even remotely close. Then you get in transaction costs, taxes. The outcome is very, very negative. So if you don't want to take the time to dig through all the academic evidence that it doesn't work, we talk a little bit about it in the book, why this is not a fantastic strategy for you and why it's not predictable. And once you realize it's not predictable, it's easier to have a philosophy to take advantage.
Even better is that when you compare it to the S&P 500 and other indexes, you'll see that U.S. small cap value absolutely destroys the other returns.
Now, 1, 3, 5-year periods aren't very important, but I thought it would be interesting to look here at what happened over a 10-year period, all the 10-year periods. He looked at the S&P 500, that was one of the asset classes, and it was number one in 6% of the 10-year periods. But small cap value ranked number one in 45.8% of the 10-year periods. I mean, it was a huge advantage in almost 50% of the 10-year periods. But by the time you got out to 20 years, the S&P 500 advantage shrunk down to being number one in only 1.4% of the 20-year periods, while small cap value ranked number one in 72.6%. And finally, and this is particularly important to the very youngest investors out there, look at the results of 40 years. The S&P 500 ranked number one in only 3.8% of the 40-year periods, but small cap value was number one in 94.3%.
Investors in this index experience returns as low as negative 40% annually to as high as positive 110%. If an investment advisor has to tell their client that they lost 40% in 1 year, they will lose that client.
I really believe that the worst will come again, but I'm hoping for the best. But if I'm going to be building a portfolio, hoping for the best but preparing for the worst, I think I got to have a good idea of what the worst looks like. And so in that same table, we show the worst single calendar year for the S&P 500. That was a loss of 43.3%. Now, we're not surprised to find out the loss for the small cap value was higher because we know that small cap value, particularly 1 day at a time or 1 year at a time or even 5 years, in fact, maybe even you'll see here 15 years, it's more risky. But you know something, if I really believed as a young person that I had the chance to make that extra 3% with small cap value, I would be willing to accept that 55.5% 1 year loss.
All that means is that there's going to be more volatility in the stock market. So for you, that means that you need to hold for longer periods. So if you're a young person, this is perfect for you. But as soon as you start hitting 60, 70, 80 years old, you probably want to carry less of this index inside your portfolio.
And with small cap value, and I love this, the worst 40 years is a gain of 11.6 compounded. That's a huge advantage. You could argue, which is really more risky in the long run, the S&P 500 or small cap value? Well, for the long run, you could say that the S&P 500 appears to be less productive. Now, we could go a step further and say, okay, which is more risky, bonds or stocks? Well, stocks are more risky, but for the long term, it certainly has historically proven to be worth the risk for that extra return. Well, 13.5 versus 9.9, particularly if I'm talking to a 21-year-old out there, that is a big deal. That is life-changing if you actually picked the small cap value for part of your portfolio. I'm not saying you can't have the S&P 500, but by golly, I do want small cap value in your portfolio, because at least looking backwards and looking at what are considered kind of average returns or compounded rates of return, both those numbers seem okay. Now, in that study I talked about, the box that shows the long-term return, then it shows the return in 15-year periods, and then it shows returns in 40-year periods. Looked at all of them, going back to 1928. The average 15-year compound rate of return for the S&P 500 was 10.8, for small cap value 16. The average 40-year compound rate of return for the S&P was 10.9, small cap value 16.2.
In summary, this strategy is based off the experience of the best investment advisors in the world, and it's based off solid historical data. After watching this video, I hope you see why I'm so confident that this investment strategy beats virtually every investment advisor in Canada. What I didn't mention in the video, and you might not know, is that I also have 3 amazing mentors. One is a portfolio manager in downtown Toronto, another one is a lecturer here at Western University, and another one is a family friend back at home who has his own investment firm. After listening to the best investors in the world and learning from my 3 mentors, I was able to create a simple and digestible investment strategy. And the reason that I wanted to do this was because investing is one of the most important things a person will ever do. And so I didn't want to just get it right. I wanted to know it so well that I could not get it wrong. So I hope you found this video really useful, and it doesn't even scratch the surface about how much more I wanted to talk about. Like, I didn't even talk about Peter Lynch or fidelity studies on the Magellan Fund. I didn't talk about like tons of case studies, and there was so much more. But this is just a sample of what there is to this investment strategy and the logic and historical data behind it. As always, if you have any questions or comments, leave them below or call me. I noticed that a lot of people have been calling me, and while I love you so much, people have the exact same questions. So if you comment below, it'll actually save me a lot of time. Anyway, that's all. I'll see you in the next video.